All right, and we should be live. Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart. Welcome you here with some very exciting news for kicking off the new year. One of the most demanded guests on this program is the wonderful Stephanie Pomboy. And one of the things I heard the most throughout 2024 was, hey, can we get more Pomboy? Well, I'm very happy to announce that we do have more Pomboy. Stephanie, how you doing?
My God, I don't buy any of that, but thank you very much.
I know, very, very, very true. And folks, Stephanie was very kind to an out to me and say, "Hey, I'd like to get myself a little bit out there more in 2025." Stephanie produces an unbelievable amount of very highly respected analysis over at her website, macromavens.com. And she basically said, Adam, I'm interested in coming on Thoughtful Money with some degree of frequency. So I think she and I talked about maybe kicking something off that's going to run bi-weekly at first, and then we'll just sort of see how things go from there after we get initial feedback from you, the audience. So that's what we're kicking off here. Today, Steph is going to just give us a brief update as to what she is seeing right now through her Macro Mavens lens. And then we're just going to open it up to live Q&A from you, the audience. And I see some folks have already started asking some questions here in the live chat. I know some folks sent some questions to you over X earlier, Stephanie. But folks, make sure if you have questions for Stephanie, you ask them there in the live chat. And when we get to the point of the program where we're going to take those, I'll start pulling them out and asking them of Stephanie. But Stephanie, look, that's pretty much all I'm going to do here. I'm going to fade back into the wallpaper and let you take it over, and then I'll come back in when it's time to ask you some clarifying questions.
Well, thank you so much for holding my hand through this, Adam. As you know, this is not my natural environment. So hopefully I'll be able to manage. I did this selfishly because obviously I know what I think and I'm constantly in that headspace, but I really needed to expose myself to other viewpoints and be challenged and pressed more. And I'm hoping that we can make this a lively conversation. But I guess to just kind of kick things off, since it is a new year and Wall Street has this obligatory annual exercise where people offer up their new ideas for the new year as if something magically changes, in the wee hours of December 31st that shifts the entire investment landscape. So I guess I feel sort of obligated to participate in this supercilious endeavor in some way. But ultimately, it probably wouldn't surprise most people who are familiar with me that my view for 2025 is not dramatically different from what it was in 2024. What is the expression? Forecast often. I guess that's sort of what I'm sticking with. And my view for those who have watched any of my interviews with Adam on this channel will know, has been fairly dour about the state of the economy. And I've been waiting, tapping my fingers on the keyboard, waiting for that to be reflected in asset prices. And obviously that hasn't happened. And I've been very surprised to have seen the, most aggressive Federal Reserve rate hikes in history, larger even in speed and magnitude than Volcker's tightening, unfold without ostensible impact. I mean, clearly there was a lot of impact. We saw a huge number of corporate bankruptcy filings. We're now seeing the increase in consumer credit card delinquencies and auto loan delinquencies. So there's plenty of stress there. But the headline markets have not really reacted at all to the tightening. In fact, their bigger response was to the Fed easing, which was kind of ironic, but not totally surprising. And so now coming into 2025, I continue to believe that the markets are massively extended relative to the underlying fundamentals. And I think now that it's clear that the Federal Reserve really has very limited runway to provide the interest rate cuts that the markets had anticipated, and that the promise of pro-growth fiscal policy isn't going to be as easy or quick to deliver upon, given what we're seeing in Washington, D.C. already. So I think that this could be a very bumpy year for the markets for risk assets specifically. And so basically, I'm carrying my 2024 forecast into the new year without apology. So I guess that's a starting point. And from there, we could take some questions.
All right, and folks, just a reminder, as you have questions for Stephanie, please ask them here in the live chat, and I'll start pulling them up. Stephanie, maybe really quickly before we do, you've said, okay, for the reasons you just listed, you think it's going to be a bit of a bumpier ride this year. One of the things about this year that's different from recent years is we're going to have a new administration. Mm-hmm. One of the things I've been talking with a lot of experts about is, Trump is running a playbook that, sort of a Reagan style playbook, go big, really stimulate the economy. Some people look at that and feel quite bullish in the longer term. And I'm curious if you do feel more bullish about the economy's longer term prospects. By longer term, I mean next 3-4 years, right, as a result of all this. Mm-hmm. But then in the shorter term, this playbook is fairly disruptive. Threats of tariffs, dismantling of government jobs, whatever disruptions might come from mass deportations, where there's lots of those people that are employed in the real economy under the table. But they are still contributing to the economy. Mm-hmm. So I'm just curious your thoughts on that. Would you characterize yourself as saying maybe more bullish long term, but more nervous short term from the disruptions, or do you have a different outlook?
No, I think that's very well said. I mean, I think that Trump, hopefully, because he doesn't have to worry about being reelected, has the ability to let the economy go through the pain in the short term that is going to be required to, bring our fiscal house in order and address some of these issues that he's suggested he wants to tackle, and not really have to have that knee-jerk response of, oh my gosh, what if the economy goes into recession? I'm going to have to, run in with some kind of fiscal stimulus. I was thinking about it actually this morning a little bit. Javier Milei campaigned on the idea that it was going to take tremendous amount of pain for them to correct the problems faced by their economy. And because he was so forthcoming and honest and open with the public about how painful this transition was going to be, they have endured that pain. And, you haven't seen any massive civil unrest or anything. He's actually been able to implement a lot of these policies and already is righting the ship. So I think as long as Trump can communicate that there will be some short-term pain to be endured in the name of achieving these longer-term goals, I think it should be okay. That said, I'm talking about for Main Street. For Wall Street, pain is not a word that there's any patience for. I mean, it's a very short term. Obviously, the short termism is just so endeared to this market right now. I mean, used to be short term was a week or even longer. Now it's a nanosecond. So, and having discounted again this very seamless transition from this overburdened regulatory state blah to something much more akin to what we saw in Trump 1.0. I think the markets are going to be disappointed because it's just not going to happen as smoothly or easily, and we're coming into this from valuations that are so extremely stretched already. I mean, this is one thing that's dramatically different from 2016. I mean, people forget that for the better part of a year and a half coming into the election in 2016, the S&P had gone nowhere. So, that's in stark contrast to the last 2 years here, where we've had these phenomenal returns in the stock market. So it just seems to me like the potential for disappointment here is massive. But again, to answer your question, I mean, I think this has the potential to set the stage for a much more sustainable long-term economic foundation for the economy. But getting from here to there is going to be far less smooth and enjoyable than the market seemed to be anticipating.
Okay. So just to pat myself on the back briefly, because it's all about me, even though this is your show, Stephanie.
It is.
Is, I've been raising this question of, hey, is his playbook so disruptive that we should, be expecting sort of a fair amount of short-term pain before we see the benefits from it? And many people, it seems like yourself included, sort of believe, yeah, that's probably likely to happen. So you mentioned Malay, and Malay ran on this platform of austerity. And the thing was, the Argentinians were finally ready for it, right? They had the status quo had gotten so painful for them. They were like, look, anything, right? We'll take anything if it promises you're going to end this pain at some point, right? So they were finally ready to take their medicine. My opinion, I don't think Trump has run to date on a similar platform like that. I mean, he's criticized the current administration's performance, but it's pretty much, here's all the big, beautiful stuff I'm going to bring you, right? And so, is he either making a strategic mistake right now by not starting to say, hey, everybody, this is even worse than I thought. You're lucky I'm here. I've got the solution, but it's going to take me a couple of years, and let's all pull together and, soldier through this. Or do you think maybe that's the plan? He gets sworn in on Inauguration Day, and then all of a sudden the messaging pivots to, okay, folks, it's going to get bad for a while. Not my fault, previous guy's fault, but, and also maybe tied to that, as the markets get rocky the way that you think they will, are we going to see a very different Trump than we saw in Trump 1.0, where he was very much anything to save the economy because that's my scorecard, or save the markets because that's my scorecard, and say, look, markets, you got to take some pain for a while.
Yeah, well, I think it's interesting because there's no rationale for not shifting the messaging and letting people know that there's going to be some pain involved with all this fiscal belt tightening, presuming that they actually intend to pursue the fiscal belt tightening, because they're certifying the election today. So it's not like there's some political downside to him having that Milei type of approach of coming out and being very forthright with the American public. So it does beg the question as to just how much fiscal discipline they actually intend to impose. And, you and I have talked about this previously, how much can Doge really accomplish? So those are open questions. As to the stock market, I mean, I think it's interesting that Trump for many, many years has really linked the stock market to the economy and said, it's a reflection of the strength in the economy. And then obviously in 2024, and when it was going up, said, the markets are anticipating his victory and that would be, bullish for the economy. And that's what the markets were saying. So I think I'm not a political wonk or anything like that. And I'm certainly not advising the incoming president. But if I were, I would strongly encourage him to stop gloating about the stock market, because when it goes down, he's going to have to own that as well. And I think it would be far better for him to just say, look, we're going to pursue all the policies outlined, that he ran on, and that the stock market's going to react the way it's going to react, but that these policies are ultimately in the best interest of the country, blah, blah, blah. I just think the stock market fixation may backfire on him if he doesn't shift that.
Okay, well, we're getting close to where it's going to stop being speculation about what Trump's going to do, and we're going to actually start seeing it. So obviously, Steph, as I said at the beginning here, you'll be coming on this program bi-weekly for the foreseeable future on this new program. So you'll be able to update us as your thinking might change as you get more data along the way.
Yeah.
All right, Steph. So we are getting a fair amount of questions here from
Yeah,
the audience. Is it okay with you if we switch over to them now?
Yeah, absolutely. I see some good ones.
Yeah, there are some good ones. Let me start here. Paul asks, the US dollar has been very strong of late. Do you believe that Trump wants a weaker dollar? And if so, what steps could he take to accomplish this?
Well, I mean, I guess if he just said he wanted a weaker dollar, that would probably accomplish a fair amount. I would say, I'm less focused on what Trump wants in terms of the dollar and really more focused on the force of reflexivity itself, which, I'm sure many of your viewers are familiar with. And that is just this idea that something like the dollar or interest rates or oil prices or whatever push to a point at which they sow the seeds of their own reversal. And we have seen the dollar just soar. And it's now at a point where on a trade weighted basis, it's really the highest it's been in 4 decades. So we have this massive headwind in the form of a stronger dollar. At the same time, we've got interest rates rising, and the two are obviously related. The dollar's going up in large part because interest rates are going up, but the two together create this massive headwind to growth and especially earnings for corporations. So I think I'm less focused on, whatever political rhetoric or job owning the Trump administration might want to do around the dollar, and more focused on the likelihood that we've already pushed to an extreme from which the dollar is going to sow the seeds of its own decline. And that's something I expect in 2025 will be different from 2024, that we will see a reversal in the dollar, not least due to what I believe will be evidence that the economy is still really in weak shape, and that the rescue squad with all the pro-growth policies isn't going to come in soon enough to arrest that. So.
Okay, so there's a chart. I don't have it available to me here, but I had it on this past week's weekly market recap with Lance Roberts that I put up of the dollar. And has been strengthening as of late. But if you look back over the past years, it's kind of been trading within this trading range, and it had actually broken out of that trading range above recently. And what I hear you saying, Steph, is in this case, sort of the cure for a high dollar, or cure for a strong dollar, is a strong dollar.
Yeah.
And so you don't expect this to be a sustained breakout. You expect this to come back down and maybe kind of, if I heard you right, maybe sort of weaken as 2025 goes along.
Yeah, no, I definitely think that we, if we're not at the peak in the dollar, we're pretty close, and that we will see the dollar trade lower in 2025. And importantly, I would underscore that when I'm talking about the dollar right now, I am including the DXY index. When we talk about the dollar, that's usually what people focus on, which is the dollar relative to major other reserve currencies. But the key indicator of the dollar strength is gold, obviously. So what I am saying, the subtext of what I'm saying here is that I expect another really good year for gold as sort of the inverse of the dollar. But I do think that even relative to other worthless fiat currencies, the dollar will begin to lose value as, this view that we are the best house in a bad neighborhood becomes challenged. On that score, it's kind of interesting. I read all kinds of wonky stuff, but I was going through the latest S&P credit ratings, global credit ratings, corporate global credit ratings, and they had a breakdown of the companies on negative watch and those that had been downgraded in the US, Europe, and Asia. And this was, developed world economies. And the credit quality in the US was far and away worse, far weaker than it is in Europe and Asia. So Japan, Germany, France, whatever, which, you wouldn't think that that were the case when you look at the way U.S. financial assets have massively outperformed all those peers. So the fundamentals in this country aren't nearly as strong as the markets perceive them to be, even relative to our G7 competition. And so I think that as that reality becomes clear, the dollar will definitely decline relative to those currencies as well.
Okay, now we're getting a number of very interesting questions beginning to converge on each other here, and I want to get through them. One of them being the cost of credit right now with bond yields as high as they are. But let me just, you more or less anticipated this question here I now have on the screen, which Green asks, is a weaker dollar good for gold, right? And you basically more or less said, yes, you think it's going to be the case this year. Is there anything else about gold you want to say in 2025?
No.
Okay. And that's fine. And that's fine. I'm sure there'll be some questions about the miners and stuff like that. But
Yeah.
I guess maybe just to put a bow on this, sounds like you think even though gold had a strong price performance year in 2024, you think the momentum is likely going to continue in 2025 in substantial part because the dollar itself is going to be weakening.
Yeah, I would also point out, and I see there were a lot of comments there that I'm sure you'll gloss over because they're not super uh, nice, let's say, about me missing the move in the markets and how I've been so negative, and I'm just repurposing the same negative forecast about the stock market. And I take complete ownership of that. But I would say, as relates to gold, while I have been negative on stocks and risk assets in general, not just stocks, but corporate credit, et cetera, on the idea that risk was woefully underpriced, my preferred investment has been gold. So you can criticize me for not, for being negative on risk assets, which just gave me the middle finger last year. But where I recommended people put their money instead actually outperformed. So the gold was up 27.5% last year versus 24% for the S&P. So I take complete ownership that the risk off scenario that I forecast to happen in 2024 did not play out. And I am repurposing that forecast or carrying it forward into 2025 because I have not given up on that happening. Gold, which was really where I put all my eggs, that basket I put all my eggs in, was actually outperformed. So I just wanted to say that for the record, because, people like myself and Dave Rosenberg and a handful of us get tarred as perma bears. He's been very bullish on treasuries for a long time, and people have been giving him a lot of, what about that? And for many years, they were really massively outperforming everything else. So it's not just what you say you don't like, but what you say you do like,
Right.
that should be counted in the final tally. That will be my final word on that subject.
All right. Well, I appreciate you grabbing that directly early on here. I was going to diplomatically ask you about that, but you went straight there and saved me the effort. So thank you. Okay, but so here's where I want to go here around this. So
I have to I should not be advertising for McDonald's, but I had to indulge my personal crack, which is Diet Coke from McDonald's drive-through. So
all right, and folks,
pardon me for that, but
no, go hydrate there with your beverage of choice. And folks, part of this new series is you'll be learning a lot more about Stephanie, like her Diet Coke
and my allergies. Other than that, we're good.
All right. Well, look. So when we talk, so you talk about the dollar weakening versus other fiat currencies, but you think it's going to continue to weaken in purchasing power versus real things, and obviously gold is a mirror for that. But everybody watching here has just lived through the big surge in inflation that we've seen coming out of COVID, right? So feel free to address this in any way you like, but just sort of about are the beatings over? Or are we going to continue to get frustrated as we go to the grocery store, buy services, et cetera? Or, are you seeing more of a true disinflation trend going forward?
Well, I'm not seeing it yet. I mean, clearly the trend is the other direction. I mean, all of the inflation measures, whether it's the CPI, PPI, the core PCE deflator, or even this nonsense super core measure that the Fed decided to focus on when everything else wasn't going in its direction, all of them are moving higher and have been since this summer. So we've had, I think 4 back-to-back readings that have been higher than they were prior. And yet the Fed has continued to lower rates in the face of that. So right now, I don't see any disinflation whatsoever. As the economy begins to slow down under the weight of these higher interest rates and the stronger dollar, those twin drags really begin to exert their force. I do think that, you might begin to see a little bit of easing, but it's not going to help Main Street. It's not like prices are going to go lower. Your bacon that went from 5 to 10 and then to 11 isn't going to go back to 5. That would take a depression. So that's going to be really hard. I think that, Trump's outlined many policies that he hopes will bring down inflation. And number one would be this drill, baby, drill and trying to get oil prices down. Meanwhile, I'm looking at my screen today and oil prices are almost up to $75 a barrel again. So it's just not going to be that easy. And obviously the markets are anticipating all of the, deregulation and whatnot that's going to come from his administration to get oil production up, although we're already producing a tremendous amount. So I think, the answer to your question, Adam, is it's going to be very hard to see material disinflation absent a major slowdown in the economy. And the catalyst for that, I think, would be a meltdown in the financial markets. I mean, I think if you had what I anticipate will eventually happen, where you get a repricing of risk and a return to normal valuations, the reversed wealth effect could really bring down the inflation numbers. But again, I don't know that when you stroll down the aisles of the grocery store, you're going to see prices be lower. Maybe they just stop going up.
Right. And even if prices come down 10, 15%, doesn't help you very much if you've lost your job because we're in a recession.
Exactly. Yeah. Exactly.
Yeah.
Or your 401k has just been wiped out or whatever,
Right.
So
let me ask this question for you to continue your answer here, right? Which is, Chandler asks, can stocks go higher with long bonds at 4.7%? So just to give you some, relief, Stephanie, you were saying, hey, look, this market's taken longer, to correct than I thought it would. You're not the only one who bears those scars. And I myself talked about the lag effect so much that self-anointed myself Adam Laggart. And yet we're still waiting for the lag effect to pull the economy down if it's ever going to. Now, the Fed has started its easing campaign with rates. But as everybody watching knows, longer term yields are actually higher than they were when the Fed started cutting, right? So we are having higher for longer bond yields, cost of capital. And mathematically, that should increase the gravitational forces pulling down economic growth and slowing it. Now, the economy, if you believe the official numbers, it grew fine in 2024.
Yeah.
Here at the start of 2025, looking at GDP now, the estimate currently is at 2.4% growth for Q1. So it shows some slowing. Now, we're very early in the quarter. That number is going to bounce around all over the place. But I guess my question, in addition to Chandler's here, which is, Stephanie, with long bonds where they are, if they remain here or go higher, what will that do for the markets? Will yields in this territory or higher also eventually just have to pull down economic growth into something different than what we lived through for the past 2 years?
Yeah, well, I mean, first, while we're on this subject, before we jumped on, was just looking at the total increase in interest rates from the day the Fed cut rates on September 16th. And today we hit exactly 100 basis points. So the 10-year yield is up precisely 100 basis points from where it was when the Fed decided to start easing. So the markets are tightening while the Fed is easing. And it is always that way. But this has been particularly profound. And I love Chandler's question because this really brings me back to Greenspan and what ultimately birthed the Greenspan put. And that was Greenspan was appointed in September of 1986. And one of the first things he did was start raising interest rates. And from September 86 all the way until October 1987, bond yields, the Fed tightened, I think, 300 basis points. Interest rates went up massively. And the stock market just, kept flying in the face of it until October of 1987, when it obviously the floor fell out from under it. And it just couldn't, as you described, Adam, it couldn't avoid that gravitational pull any longer. And that experience so chastened Alan Greenspan that he became father of the Greenspan put, and always and forever after that erred on the side of accommodation over restraint. So I think that, really is very much ingrained in my memory. And I think that when I see the stock market go up in the face of rising bond yields, it definitely puts me on the edge of my seat waiting for, when what's going to hit the fan. The one difference now is that when you look at, you're talking about treasury bonds, Chandler's referring to treasury bond yields. However, when you look across the credit markets, obviously it hasn't been as profound. In fact, junk bond yields are only up 25 basis points from when the Fed first started easing. Now they're up, which again, flouts the Fed easing in that clearly conditions are tightening for junk rated borrowers, but they're not tightening as much for junk rated borrowers as they are for the federal government. So there's still this sense of risk appetite out there that hasn't abated in the face of these higher rates. I think, they're going to get spanked hard for that, because the reason the risk appetite is still there is this expectation that the higher rates will be rendered moot by the forthcoming growth in the economy. That all of a sudden debt service won't be an issue for these companies that are massively levered and rolling their debt at rates that were twice what they were prior, because they're going to be awash in income from the boom in economic activity that's going to take place. But the handoff from one to the other is the key, because sure, maybe growth will pick up at some point, but it's not going to pick up tomorrow. And in the meantime, those debts are coming due tomorrow. So it's a problem.
Well, so this is what I was actually just about to ask you next. So I'm really glad you brought it up here. Liquidity has been something that's really carried this market a lot, and the sort of the maestro of liquidity from an analyst standpoint, Michael Howell, he's actually quite concerned about what's going to happen with liquidity. One, because he charts these cycles, and while 2025 will continue to be an upcycle year, it ends. It hits its peak at the end of this year. So the impulse, like when you throw a ball up in the air, is slowing as we go through 2025. It's not going to be propping asset prices up as much as it was. And that's just a natural cycle. Now, unnaturally, we have this corporate debt maturity wall that we're really hitting in earnest in 2025. And Michael says that's going to act like a liquidity sponge, pulling liquidity out of the markets. You just referenced that for a lot of companies, they're going to be taking debt on the books at twice the cost of what they've had on there for the past several years. So how concerned are you about that? And, we talk about credit spreads being the important canary in the coal mine to watch. You just said more or less that they're still really tight. They're not blowing out yet. Policy acts with a long and variable lag. I mean, we know that. So how can the market be mismanaging right now this expectation that, the economy is going to start booming again, so let's price that into everything, without Yeah, and that's going to take a while, as you said, for that to fully manifest. Even if it does, there's some uncertainty that it won't, right? Versus we know the cost of capital for much of corporate America is going to get more expensive over the next 12 months. That's a certainty.
Right.
So why is there such a disconnect right now between what folks are hoping for versus what we know is going to happen?
It's interesting because there's actually, as far as I can tell, there's $1 trillion in corporate debt here in the US that rolls next year. There's another trillion in commercial real estate tied debt that rolls. And then let's not forget about the federal government. I mean, the amount of borrowing that's coming from Treasury because of our financing the deficits with T-bills is enormous. I mean, I came up with a number of a month ago of 10 trillion in terms of 6 trillion worth of Treasury bills and 4 trillion in coupons. So, I mean, the point is the competition for capital this year is going to be fierce. But as relates to the question of how the markets can just blow past this increase in debt service that's going to happen, again, I think that it's on this hope that it will be rendered manageable by increased earnings. And the problem, as you said, Adam, is that those earnings have to, come immediately. And I guess I was just reading FactSet before this, and in the fourth quarter, I think earnings are forecast to be up 11.5% or so, which is the fastest rate of earnings growth since the fourth quarter of 2021, I think. So, right now, the burden of proof is on me because the earnings numbers have been good. But again, what we're doing here is we're painting the corporate sector with one brush, and that really doesn't work in the current environment. We've talked about this, the amount of corporate bankruptcy filings has been the largest since the global financial crisis. That clearly isn't anything that's reflected in credit spreads. However, that is the reality. And it's because these companies that are filing for bankruptcy are all small to mid-sized companies. They don't capture the attention of Wall Street. But eventually, we're going to feed up the chain because it's not as though those bigger companies aren't also levered. And when you look at the breakdown of earnings growth, you see how enormously skewed it is between the haves and the have-nots. According to FactSet, the Mag 7 have 33% earnings growth. This was year-on-year earnings growth. And excluding them, I think the average was 4%. So it's a massive schism between the two of them. And that's the top 500 companies in the country. So forget about, when you get to the Russell. In fact, you and I know this, that almost half of the Russell small caps aren't generating any profits at all. So it's really a case of the haves versus the have-nots. And the question is, when do the problems of the many begin to be reflected in the fortunes of the few? How long can the Mag 7 be bulletproof while the rest of the universe is really struggling? And I guess that's a rhetorical question, but my answer to it would be, we don't know how long, but it's not forever. So
yeah, and on that, so we have people talk about the breadth issues of the market right now, right? Which is, you just mentioned that all the earnings growth is concentrated in these few stocks, but similarly with market cap, right? And so we've never had as much market cap concentrated into a small number of companies as we do today. We've never had as much of the international the global stock market concentrated into the US as we have today. So basically everybody's in the US, everybody in the US is in these few stocks, right? I mean, just from a systemic vulnerability standpoint, how much does that concern you? Because if those few stocks are driving everything, if we get to the point where they aren't anymore, did they have the potential to take everything down with them?
Well, one would think so, especially with all the passive, I mean, the ETF, the whole passive industry. And I mean, basically self-reinforcing. You, I'm sure, have talked to Mike Green about this previously. So it would seem for sure that if you start picking apart those Mag 7 companies, it's lights out for the broader market, at least initially. And then maybe you get back to, this is sort of the dream of those of us who actually thrive on doing fundamental research, is that, you know, maybe you get to a point where this whole passive strategy gets called into question, and you can get back to the business of analyzing individual companies and, you know, actually having discrete investment ideas rather than just throwing all your money into some basket that ends up reflecting only 4 companies anyway, you know? So I guess, but it would take a real correction in the stock market to bring that about. But yeah, I mean, when you look at things like the consumer discretionary sector, earnings are up 12.8% year on year. If you take Amazon out of that, they're down 0.2%.
Jeez.
So, you know, it's like the consumer discretionary companies are in recession, and yet you couldn't know it to look at the performance of the index. So, I mean, basically everyone's just long Amazon, and that's the game.
Can I ask you a larger societal question around this, which
Sure.
is, so clearly the spoils are concentrating in today's economy, right? And, you know, one can say, well, that's, you know, what government intervention kind of gets you. The government starts picking winners and losers. We also had COVID, where we basically shut down huge swaths of the economy, but we kept essential businesses open. And, you know, a lot of Main Street had to shut down while everybody was getting deliveries from Amazon, right? It doesn't seem like that momentum is slowing at all, right? Like the concentration just is continuing to build into these fewer and fewer big corporate names. What are your thoughts on that, just from a societal standpoint?
Well, I mean, I had been worried for a while about the potential for civil unrest as a consequence of that, obviously. But, you know, I guess if we get the recession and the markets have a real revaluation, you know, if we return to some more normal valuations, the pain at the high end is going to be material. So, I mean, the pain everywhere is going to be material, but the high end is going to really get slammed for the first time in a while. And so maybe that helps to sort of, you know, what is it? Misery loves company. I don't know. I mean, maybe that helps to at least even out a little bit of this gap. It's obviously not the way you would like to even out the gap. You'd much prefer to see the low and middle move higher. And maybe in the long run, that will be achieved by ridding all the excesses, both from the financial markets, but also from the federal government, you know, these welfare states, et cetera. And these crazy, you know, like COVID stimulus, as you were saying, once we can wring all those excesses out and go through the hard times, we will have a society where things aren't nearly so top heavy. That's the goal, I would assume. I mean, that certainly would be my hope. And I think that's really what the new administration is hoping to achieve, albeit clearly not by deflating the asset bubble,
Right.
but by, you know,
Pulling everyone up. Yeah.
Right. Exactly.
Okay. So folks, if you didn't if you haven't been watching since the start, you're a late joiner here. Just a quick reminder that this is a new segment that we are piloting on Thoughtful Money, where it's more or less the Stephanie Pomboy show. In future episodes, the goal is for me to be here less and less, and for Steph to when she gets the technology underway, it'll just be 100% Stephanie, which is, I know, what everybody would prefer here. But
that terrifies me, but I'll
no, don't worry. And I'll always be here if you need me, so don't worry. But folks, the intent here is for Stephanie to share with you her latest thinking on her analysis that she does over at her website, Macro Mavens. But then importantly, just to answer whatever questions are most important to you all, folks. So I am going to pull a few more hear from the live chat, Steph, and maybe not curveballs, but maybe a changeup or two in here.
Okay.
We'll toss to you. But folks, if you can, please just give us a quick chime in the live chat here. How you think Stephanie's doing. If you think she's doing a good job, please give her a warm welcome and some encouragement. And if you're enjoying it too, please also hit the like button too. That does help get this video out there into the YouTube universe. All right, Steph, so here's a question about the debt ceiling. And I'll let you answer this any way you like. He's asking a very specific outcome. If we remove the debt ceiling, will we then get out of control inflation and the bankruptcy in the long term? Maybe just the better question is, you know, Trump has basically said, hey, look, let's remove the debt ceiling constraint, I think pretty much for the tenure of his administration. Do you think that's the right thing to do? What do you think about the debt ceiling in general? I mean, it almost doesn't really even seem to be a real thing because it just always gets raised. But, you know, should we just get rid of it, or should we put some other controls in place that would have more teeth? What do you think?
Yeah, well, I mean, my answer was going to be that you may as well get rid of the debt ceiling because it serves no purpose whatsoever because it always gets raised, as you said. So I think that's why Trump wants to, you know, get rid of it, because we play these fun, you know, these stupid games down to the wire constantly. And then at the end of the day, they always end up raising it. So it's just, you know, it's a lot of political theater that creates a lot of unnecessary stress and doesn't need to be there because it serves no purpose. But I do totally agree that we need to have something more stringent in place in lieu of that. And there has been, you know, over the years, proposals to enact a balanced budget amendment that actually requires, you know, to keep a balanced budget, sort of similar to what the state and local governments have, almost all of them. So that would be an idea. Of course, I don't know any politician that would vote for it. You know, I think that's the problem. I mean, it would be sort of like asking the Federal Reserve if they would voluntarily go back on a gold standard. I mean, they're just not going to do it. It's the same idea for the federal government, and the two actually are related, because if the Fed went back on a gold standard, it would naturally constrain the ability for the government to run these massive debts, since they have no source of financing going forward. But that's a topic for another day, perhaps. But so, yeah, I mean, the debt ceiling debate is all, you know, show. But I would love to see a constitutional amendment. Again, getting something like that passed is probably not going to happen. And if it did, the near-term pain associated with something like that would be pretty severe.
There was a question here that I'm having trouble finding. It was about Elon Musk, and it wasn't super complimentary, but let me ask you this. You know, was it Abraham Lincoln famously had the cabinet that they called the team of rivals? Trump has built not so much a team of rivals, but a really interesting kind of rogues gallery of people. And I guess the question I have for you is, you know, he's pulling a lot of people into politics who aren't traditional politicians. You know, the Musks of the world, the Viveks of the world. I guess any, you know, we're not political analysts. We chart a very apolitical course here at Thoughtful Money, but we have to talk about what's going on in politics when it impacts economic policy. What are your, I'm just curious if you have any thoughts about the strategy here of pulling in these interesting, some might say idiosyncratic people into the political world.
I mean, I love the idea. Again, I come back to sort of that Federal Reserve analogy of, you know, maybe getting some people who are not ivory tower academicians at the Federal Reserve. It would be equally nice to have some people that aren't career politicians working in Washington. And having a cabinet that's comprised of people who have actually run businesses, who understand how it actually works and have dealt with the regulatory state, et cetera, is all hugely positive. But again, we come back to the question of how do you implement these policies? How do you create a consensus among the people who have that business background and the people in DC, the elected representatives who actually have to get that into some policy that can be enacted. That interplay is going to be interesting to see unfold. And this idea, that it's all going to be so easy seems kind of overly sanguine. It's everyone has their political interests, and they're still going to be looking out for that. Even if Elon Musk and Vivek are trying to get them to, pursue some real belt tightening there. So I think it's going to be interesting to see how that all plays out. Hopefully they will be able to really get something accomplished. I mean, there's a lot of talk from both sides of the aisle about the willingness to impose some fiscal discipline and how things have gotten out of control. But, we've heard that talk before, and here we are at 36 trillion. So, color me not exactly confident that this is going to reap. I definitely don't think that $2 trillion savings number that I think Elon Musk talked about with Doge is going to be anywhere close to what they're actually able to accomplish. I mean, I think if they were able to shave 200-300 billion, that would be a triumph. So it's going to end up being far less material, I think, than they have suggested. I mean, I remember looking at what the total payroll of federal government employees was, and it's 700 billion or something like that. So even if you fired everybody on the federal payroll, you still wouldn't come anywhere close to what they're suggesting. So I mean, I think it's not going to be easy. I also spoke with someone who was very involved with Trump's first administration. He's a name everyone would know. And he's a very sage advisor to Trump. And I was talking to him specifically about Doge, and he said, they're not going to be able to get very much done at all. He said the problem with all of the federal government bloat is that every department is incentivized to grow, not to shrink. You're the more employees you have, the bigger your budget, the more projects. That's the incentive. All the incentive structure is designed to support growth, not contraction. And so they're going to have to turn the incentive structure on its head, which probably isn't going to be super easy, and certainly won't happen overnight. So I think, again, there's just another area where the markets seem to be believing that it's going to be really easy and quick, and that's not going to be the case. And in the meantime, they're going to have to deal with this headwind of higher interest rates and the stronger dollar and higher oil prices. And all those realities are pressing harder and harder every day.
I've asked this question, and I think I know what your answer is going to be, but let me ask it of you directly. So Trump's inauguration is coming up. Do you think that's going to kind of be a buy the rumor, sell the news type of event, where right now the animal spirits have just been, it's all going to be great, but reality is going to start setting in?
I mean, I feel like we may already be selling the news. It just feels like the markets have been trading pretty heavy. And while the spreads are still very tight, they have started to creep higher. We have junk yields back at 7.5%. Which is, a pretty meaningful yield. So we are seeing a little bit hints around the edges, let's say, of some risk aversion. And obviously we had, 5 days in a row with the markets down. So I think that, if they haven't sold on the news already, sure, January 21st is just as good a day as any. But I agree with the broader thesis that, the anticipation of Trump 2.0 was exhilarating. The reality may prove, to be less enjoyable. I mean, let me just say, definitely more enjoyable for the economy and the markets than the alternative would have been, and hopefully really good long term. But I think we've discounted so much of what's going to happen forward that it's going to be rough sledding for a little while.
Okay. All right. Well, we are coming up on the hour, so I've just got two more questions for you here, Steph. But I think we're proving the thesis, Stephanie, that there's going to be an inexhaustible number of questions for you when you come on every week. So I think that bodes really well for your future appearances here on this channel. Let me just ask this one here. Any book recommendations? I would open it to anything, but I'm going to guess the spirit of the question was probably like around investing or economics or whatnot. But there's an interesting read on Stephanie Pomboy's table. That's not economic related. I'm sure folks would love to hear about it.
Well, it's right over my shoulder here. Atlas Shrugged. Would always be, if you haven't read Atlas Shrugged, go out there and get it. And while it may not seem to be a book on investing and economics, in many ways, it really is. So I would highly recommend that.
So I get asked about Atlas Shrugged a lot because the protagonist in the story, Dagny Taggart, her last name obviously is mine. But Steph, if I were the casting director for a remake of Atlas Shrugged, I would pick you as Dagny.
You would pick me as Dagny. You can't pay me a higher compliment than that. I love it. I absolutely love it. When I read the book in college, my dad would call me Dagny, and that was always just made me so happy. I love that. Anyway, it's a great book. I highly encourage people to read it. In terms of financial literature, though, and I'm going to make a plug for someone you've actually had on this show here that I think I introduced you to, and that's Peter Atwater. Mm-hmm. His book, The Confidence Map, talks about, it's interesting because, again, not ostensibly an investment book, but in many ways really integral to investing. And he talks about, different patterns and behaviors. And when you can identify things like extreme despair, or as he calls it, vulnerability versus extreme confidence, and that would help you identify, major turning points in economic cycles as well as the markets, et cetera. It's just also a fascinating read because you get insights into your own sense of, how vulnerable you feel in certain times or situations versus your confidence. And it's a really good read and not a very long read. So for those who, like me, have a short attention span, it would probably be a good one.
All right, great. Well, so we're here on the last question, which is, Stephanie, is there anything that I or the audience hasn't asked you about yet today that is at the forefront of your mind that you think is worth sharing with folks?
Well, I guess, I had asked myself this rhetorical question at the end of last year when I was looking back on 2024 and the recession that never arrived. I had forecast this recession unfolding in it, along with many other people at the beginning of 2024. And
almost everybody at the beginning of 2023 thought it was imminent.
Yeah, which should have been an indication that it was going to be wrong. But so I sort of had this, if a tree falls in the woods and it doesn't make a sound, if no one's around, does it make a sound?
Right.
Sort of question, because while in 2024, by the NBER standards and by the real GDP measure produced by the BEA, we did not have a recession. When you look at corporate bankruptcy filings and consumer credit card delinquencies and the downtrend in real retail sales and, any myriad number of indicators, that leading indicators, the 1 million decline in full-time employment, all of those things are the worst since any recession. And in the case of the delinquencies and bankruptcy filings, the worst since the worst recession in our lifetimes in 2008-9. So yes, ostensibly the economy was not in recession, but if every indicator out there other than the one real GDP measure that the government produces is screaming that we're in a recession, the rhetorical question I ask myself is, does it matter? When you look at the markets in 2024, the answer would seem to be no, it didn't matter that, people were falling behind in their bills and companies were folding up, and, people were buying fewer units because they couldn't afford to buy more stuff at higher prices. It didn't have any bearing on asset prices. And so I asked that question to myself to try to figure out, like, okay, well, if we come into 2025 and growth, if anything, is going to be stronger as we get, these pro-growth policies, and, the Fed at least isn't tightening, it's in theory going to keep cutting rates. Does it matter that we ever had this situation? And I guess my answer to it was sort of twofold. Number one, if it turns out that in 2025 we don't get the acceleration and growth that the markets are anticipating, then one presumes it will begin to matter. And number two, it suggests that the valuation extremes are even more profound. If you're talking about markets that have completely ignored what's going on in the underlying economy because they believed these sort of glossy headline statistics that don't really have any bearing in the real world, then you're talking about a valuation extreme that's even more profound, and a mispricing of risk that's even more profound. So it's sort of a satisfying intellectual endeavor that I went through. But I thought it was kind of interesting because, that was my one takeaway from 2024, is that pretty much without exception, every single major economic indicator was in recession, with the exception of real GDP. And to believe real GDP, you have to take the government's accounting of inflation.
Right.
And, I think there are very few people out there on Main Street who believe that inflation was really 2.7% year on year. That would just be my guess.
I don't think you're going to get any disagreement in the comment section here from folks, Steph. So yeah, all right. So look, lots of things we didn't even get a chance to talk about related to recession. The reversion of the yield curve. We didn't talk about the employment market. We didn't talk about the prospects for the housing market. All these things that really weigh on consumer spending. But again, that's why we're going to be doing this on a regular basis going forward. So folks, I hope you've enjoyed this inaugural launch of the Stephanie Pomboy Show here on Thoughtful Money. As a reminder, we're going to do this bi-weekly for the next month or two or so, see how it goes. If it works for Stephanie, if it works for you as the audience, then we'll hopefully make this thing permanent going forward. But please let Stephanie know your comments on what you thought about this in the comment section below. If you enjoyed it, please do hit that like button. Reminder for folks that if you want more Pomboy in between Stephanie's appearances here, you can go catch her at her website, macromavens.com. Stephanie, anything you want to tell people about what you publish there?
So I have a weekly commentary that's actually mostly for institutional investors, but retail investors can sign up for that. Or alternatively, they can subscribe to the monthly commentary, and that will give you a pretty good sense as to my thought process. And obviously, I'll be here holding forth and taking questions, which I'm really enjoying so far on the first go round. I mean, it was fun. And you can follow me on Twitter. Other than that, I generally keep a very low profile.
All right. Well, Steph, it seems like everybody else really enjoyed this too. Just so you know, I don't know if you are able to watch the comments while you're talking, but it seems like definitely the vast majority of the audience here really had fun. So folks, really looking forward to doing this, like I said, on an ongoing basis going forward. For those listening, Stephanie's X/Twitter handle is @spomboy. So feel free to follow her there. Also, just a quick reminder, Stephanie is basically making the case that we're going to have a bumpier ride ahead in 2025 than we had in 2023, 2024. If you would like some help in navigating that, highly recommend you get it from a good professional financial advisor. If you don't have one, or you'd like the second opinion of one who thinks an awful lot like Stephanie, consider talking with one of the ones that Thoughtful Money endorses. These are the financial advisory firms you see with me on this channel week in and week out. To schedule one of those free consultations, just go to thoughtfulmoney.com, fill out the short form there, and the firms will be in touch with you immediately. Stephanie, Just been so much fun. I mean, this has all been something that we were planning on doing. The fact that we've actually done it, I had a great time. I hope you did too.
I did. I had a great time. And I really appreciate you holding my hand through all this, Adam, because it's going to be a lot for me to figure out. But I'm looking forward to getting my feet wet.
All right. Well, Steph, thanks so much. I'll see you back here in 2 weeks. Everybody else, thanks so much for watching.
Thank you.